bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the July 14th, 2026 episode. As our audience on YouTube can see, my guest this week is Karie McMillen. Karie's a partner in Novogradac's Dover, Ohio office. Karie's one of Novogradac's leading experts on low-income housing tax credits, which makes her the ideal guest for today's subject, which is, drumroll please, the 10% test. As many of our audience know, developers of affordable housing that are using low-income tax credits for which they're getting an allocation of credits from their allocating agency, this is as opposed to private activity bonds, but those using what are often referred to as 9% credits, even though technically for an AC rehab, you can get 4% credits on the acquisition cost, even though you get an allocation of credits, much more than you wanted to know. But those using allocated credits must incur at least 10% of the reasonably anticipated project costs of their development by a specific date. And way back when, I started referring to this as a cliff effect test. The idea being that if you don't meet the test, then you fall off the cliff. And no one wants to fall off a cliff. So that's why we refer to it as a cliff effect test. If you don't meet the test, you lose your eligibility for the allocated tax credits. And I'll note that it's not just important that you yourself think you met the test. It's most important that the investor, and beyond that, the investor's tax attorney, thinks you met the test. So it's definitely an area where you need to be very, very cautious and concerned. So in today's episode, Karie and I will discuss what developers, investors, syndicators, and others we believe should know about the 10% test. This is once again going to be at a high level. It's not going to be sufficient to be able to just listen to the podcast and know enough to pass the test, but it's making you knowledgeable enough to anticipate what the various issues are when you're working with your CPA and tax attorney. In addition to talking about the mechanics of the test, we'll also discuss some of the potential hurdles, as well as some of the challenges. We'll discuss some recommended practices for complying with the test. Because once again, since you need to ensure that the tax attorneys and investors are comfortable that you've met the test, that you passed the test, you'll want to stay within normal industry bounds. We're also going to touch upon how the 10% test came. Later this year, we're going to be celebrating 40 years of the long-lasting tax credit. So I'm a little bit more focused on history over the last few months, over the coming months than I normally am. As you probably suspect, this is going to be part of our ongoing So You Want to Be a LIHTC Developer series. That is a series that aims to give housing professionals that work in long-term tax credits various entry points to the life cycle of developing affordable housing. I will include a link in today's show notes to the playlist for this series. And I will note that the playlist seeks to follow the life cycle of an affordable housing development. I do know of many clients and future clients who do have new hires go and listen, binge watch, if you will, the YouTube series in order to get up to speed on what it means to be a long-term tax credit developer. And I will note that in looking at the life cycle of affordable housing development in this series, we go from the very beginning of location and market considerations all the way out to year 30 considerations. Now, one last note for our audience before Karie and I get into today's discussion. I'm pleased to announce that Tax Credit Tuesday has expanded our reach. We're now available to stream via Amazon Music, Audible, and iHeartRadio podcasts. Appreciate everyone who listens to and engages with the program, no matter which your platform is. So thank you for watching and listening over the years. With that said, a lot to discuss today. So if you're ready, let's get started. Karie, welcome back to Tax Credit Tuesday.
Thanks, Mike. I'm happy to be back.
Now, this is your third appearance on Tax Credit Tuesday. However, your last appearance was in June 2024. It was for an installment in the So You Want to Be a LIHTC Developer series, which provided our audience an overview of what's important during the development process. However, our partner, Dirk Wallace, was the host of that episode, which means this is actually only the second time you and I have been together on Tax Credit Tuesday together. I will, by the way, link to the episode in today's show notes. For our audience that didn't catch that episode, or for those in our audience where this is their first episode of Tax Credit Tuesday, before we get into the 10% test, as I do every week, Karie, please share with our audience some of the services you provide to Novogradac clients.
Sure. I provide a variety of services to LIHTC developments, tax-exempt bond finance developments, and regulated entities. I would say I focus more on the early phase and into the annual audit and tax requirements of those entities. So the 10% test is right up my alley.
Thank you for that, Karie. I would like to set the table for our audience about the history of the 10% test before we unpack what it is and what developers should know about it. For context to our audience, when the LIHTC test was enacted in 1986, there was no such thing as a 10% test. And you might be thinking, okay, then how were credits calculated? How are you determining your eligibility? Well, developers back in 1987 had to apply for and receive an allocation of tax credits in a given year and place their buildings in service during that same calendar year. Basically, go apply for credits and place your building in service during that, all within the same calendar year. Those listening that are familiar with the development process know that seems like that would be pretty hard to do. And that's certainly true if you didn't start your construction before you applied for the credits. And you might be thinking, well, what does that mean for those initial years? Well, basically means that in the initial years of the credit, which weren't very many, the loan for the tax credit basically financed light acquisition rehab transactions where you could buy the property, do a light rehab, and place it in service by the end of that year, as well as financing market rate housing that was already under construction that converted to low-income housing tax credit, affordable housing midstream during the development process where they could place in service by the end of the year. I should also note that I personally, back in the day, worked on some for-sale housing, single-family homes that were started development before the enactment of the low-income tax credit that converted to rental under the low-income tax credit incentive. But that did change pretty quickly. And Karie, I'd like for you to share with our audience what happened in terms of how the 10% test was created and how it has evolved over time.
Sure. And I'll definitely say to start off that I will love to talk about the history of it when I wasn't even born yet in 1986. But I'll start with the Technical and Miscellaneous Revenue Act of 1988. This brought about the requirement to be placed in service within the calendar year. So then under
just to elaborate on that, since I wasn't born after the 86 Act, I was present and serving duty at the time that the Technical and Miscellaneous Revenue Act of 1988, which is commonly referred to in the tax world as TAMRA 88. TAMRA had a series of technical corrections to the low-income housing tax credit. Obviously, it was 1988, so you only had 87, and then early of 88, where you were working under this old place in service and allocation same year test. And it basically acknowledged that you can't realistically do new construction planning to use the low-income tax credit and have to place the building in service in the same year. So they created an approach saying, well, you should have 2 more years to be able to place the property in service, but they did want you to have some level of activity in the year you got your allocation. They basically said, we want you to pass this 10% test in order to move forward with your allocation. And that was the middle ground. You've got to get your allocation and incur a minimum amount of costs, this being this sort of 10% of costs. And that's what TAMRA 88 sort of created. However, as you were expanding to, please share how that test evolved.
When under the Housing Economic and Recovery Act of 2008, which you'll hear me calling HERA going forward, the timing for meeting the 10% test was extended. This applied to buildings placed in service after July of 2008. So now under HERA, the buildings they're given a 12-month, a year period from the date of allocation to meet the 10% test. Whereas before, as you said, Mike, the deadlines varied for developer based on when those allocations were given. So under HERA, it smoothed out the timeline to meet the 10% test for all developers as they had challenges out of their control, such as construction delays or obtaining and securing financing. HERA was very beneficial for properties facing those obstacles. And again, it didn't change how the 10% test was calculated. It was just the requirement for the due date of the 10% test and when those costs could be incurred.
Right. And that was something that, once again, knowing that you weren't all that old in 2008.
I was out of high school by then.
Do you have a little bit more reporting on that as someone who is, once again, there in service? The concept was obviously the 10% test with a calendar year deadline was better than what was there with the original act, but it did create challenges where you would get an allocation and have to rapidly incur 10% of your project costs before the end of the calendar year. So that was better, at least possible to do, but was still burdensome. And it didn't make a lot of sense to have such an artificial deadline. It made more sense to focus it on when you got your allocation and incur your costs within that time frame. So this was a part of, once again, another broad set of enhancements to the long test improvements that occurred with HERA back in 2008. And those of you that have listened to the podcast dealing with income calculations and rent calculations for taxable properties know of HERA specials and things like that. That is the same HERA in terms of the Housing and Economic Recovery Act of 2008. So now let's talk about the actual 10% test, the reason why we're recording this podcast in terms of how it operates today. And when I think about the 10% test, I think about it in some ways as 4 parts, maybe it's 2 parts. Because I think of the overall calculation as one part of the test, but I think there's the overall calculation, but then there's also what's in the denominator and in the numerator. And when you think of the 10% test, you think 10%, right? So you got to say what's in the top, and that's the numerator. What's in the bottom, the denominator. So I want to have you go through and talk about the details of that in a very mechanical, accountantish way. I also want to have you talk about the timing of the test, dig down a little more deeply in terms of when the test has to be satisfied as of rules today. Let's start with the first of these 4 parts. Once again, overall calculation, denominator, numerator, and timing. And I say overall calculation, and then I start at the bottom with the denominator, then talk about what's on the top, the numerator, because the numerator is a subset of the denominator. And if I haven't totally confused our listeners by now, just wait, there's time. And then we'll talk about the timing of the calculation. So Karie, if you could give insights in terms of what the overall calculation means and maybe a simple mathematical example of the math behind a 10% test.
Sure, Mike. The denominator of the 10% test represents the total reasonably expected basis. I might say TREB if we refer to it later, because
Okay.
the other name is, it might get tongue-tied, but that basis is your total cost to be incurred. And in relation to the 10% test, 10% of those costs of your TREB need to be incurred. So for simplicity, if you have 10 million in costs that are going to be incurred, you need to incur 10% of those costs to pass the 10% test.
Great. Thank you for that. And that's the basic. If you have 10 million of costs, you have to incur 1 million plus of costs to meet the 10% test. So now let's talk about that denominator. You said totally reasonably anticipated or expected basis. What is included in reasonably anticipated basis?
To make it pretty simple, we'll say land and depreciable costs in this umbrella. So you will want to include all of those costs, with land being a huge factor, both in the denominator and when we get to the numerator. And then other costs that are not included in that basis would be items such as loan costs or other amortizable costs, such as tax credit fees, that would not be included in your depreciable basis.
And that depreciable basis generally will include development fee if development fee contracts are structured properly, architectural, basically, as you mentioned, what are considered hard costs, those items that get capitalized and depreciated and or get capitalized as part of land. And as you noted, doesn't include the amortizable costs. So that's the denominator. And obviously the importance of getting the denominator right is that's your measurement of the 10%. And as you note, this is reasonably anticipated. It's not necessarily what they actually, well, almost by definition, it won't be what actually they are, because as every forecast is wrong, just a question of how accurate they are. And hopefully they're not materially inaccurate. So it is reasonably anticipated as opposed to what the final ultimate costs are. Now let's turn to where most of the work happens, and that has to do with the numerator. And as you noted, the numerator are the costs incurred by the deadline. And if you can give some examples for our audience, of what a typical 10% test, what are the costs that are typically incurred to get included as part of the 10% test?
I'm going to break it down to focus on 3 items here. I'm going to focus more on land, personal property, and the developer fee. For land, again, this will most likely be a huge chunk if the land is acquired of your costs incurred and your total costs to be incurred. For land, you want to make sure that the property has ownership at the time. So cash, obviously, the transfer has taken place. But if there is a debt used to acquire the land, it is important that the ownership has switched hands and that the debt has specific terms for repayment. You want to make sure that it's not going to be forgiven and it's contingent on performance of the property. So make sure you have those documents in hand to show the transfer for land to be included in the numerator. Secondly, the personal property, you would think it's going to be included, but if sometimes you might see a developer getting down to the wire and it's crunch time and they may go purchase a bunch of personal property. Well, purchase doesn't necessarily mean incurred for the 10% test. It is important to show that the personal property, these materials have switched hands. If they are being stored off-site somewhere, there might be a storage or bailment agreement in place to show that these materials are belonging to the property itself. And also, this personal property should also be insured. So if all of those are met, the personal property can be included in the 10% test in the numerator. Lastly, we'll touch on the developer fee. AHIC underwriting standards, they suggest that the developer fee to be included in the 10% test is limited to the ratio of development services completed as compared to the total development services. In practice, I typically see about 20% of the developer fee being included in the 10% test. But again, it's always important to refer to the development agreement, which has milestones laid out to see what is earned during construction.
Great. Great. Thank you for that. And I appreciate you referencing AHIC, which is the Affordable Housing Investors Coalition. As I had said in the introduction, it's not just that you, the developer, thinks that the test was met. It's that the investors think that it's met. AHIC, the Affordable Housing Investors Coalition, has a series of underwriting standards. And what Karie just mentioned were some of the standards with respect to 10% test, which is once again, one of the reasons why you want to make sure you're working with experienced accounting and legal advisors with respect to the long-stay tax credit. So they're aware of these other standards that you want to make sure that you satisfy. And I'll just share other thoughts that I have on this sort of 10% test. I definitely think back in the day, it was much more challenging because of the calendar year deadline and having to rapidly meet these tests, that a lot of the tests had to focus on certain areas and rapidly incur the costs, such that personal property was used a lot in certain other types of property. I do think that with the HERA change, since there's more runway for the project to actually get more physically developed, an area that many projects are less sensitive to, the struggling to get to the 10%. But just taking each of the categories that Karie talked about, like with land, and maybe before that, I should say overarching is this concept of benefits and burdens of ownership. And what Karie was going through is some of the practical ways in which you demonstrate the benefits and burdens of ownership have transferred from the person that used to own the property to the partnership. And that's why with land, Karie was mentioning the loan, the importance. If you bought land with 100% non-recourse debt, then the question is, did the benefits and burdens of ownership actually transfer from the seller to the buyer? If the buyer defaults, all the seller does is get their property back. In that situation, the general standard will be at least 10% down, or at least 10% of the note be non-recourse. Personal property, all the areas that Karie was mentioning about, if you buy personal property, if you don't take physical possession, if it stays in a warehouse, you need to ensure that the benefits and burdens of ownership of that property has transferred to the partnership and isn't still with the owner of the property. And then on the accrued developer fee side, those sort of standards are all about, in substance, what services have provided at that date. Someone's aggressive on the accrued developer fee, the IRS could come in and say, we don't think that validly represented the portion of services provided at the time. And then these overarching guidelines come in. But I would just leave it with benefits and burdens of ownership have to transfer. And not only do you have to, there's a developer to think they transferred, the tax attorneys have to really give a tax opinion, ultimately, that they transferred. Anything else on the numerator you wanted to expand on?
Yeah, I want to say those are just 3 areas. Land can't be included in the numerator. That doesn't mean the 10% test isn't met. There are so many other costs that go into the numerator that can fill that gap, just as long as 10% is met. And I know we keep saying 10%, but usually you want to get around 13 to 15% to have that cushion. But again, there are so many other hard costs included in the calculation and other costs related to the construction that if land or personal property or a portion of the developer fee isn't included, that doesn't mean the test won't be met.
No, I appreciate you mentioning that, particularly focusing on land, because some in the audience are saying, well, wait a second, I have a long-term land lease. What are the implications of that? And there are some interesting implications of that, which we're not going to go into here. I'll just note there are a lot of other areas here: treatment of commercial space. How do you treat developer fees if they're in excess of state limitations, they're otherwise allowable? There's a lot of other sort of issues embedded in all of this that we don't have time to go into here. We did say time to talk about timing. So we've talked about the denominator, the reasonably anticipated basis. We've talked about the numerator, which is you have to incur 10% of the sort of project costs. We've talked about the timing changes from HERA 2008. Please expand on the timing requirements.
The first date to hit on, I think that's the most important, is the due date. And we mentioned this earlier, but to reiterate, the due date of the 10% test is going to be a year after the allocation date. So we'll get into it a little later about the carryover agreement, but the date on that is what starts the clock.
And that's federal.
Yes, the federal rule, yes, because there are different federal and state requirements, but we're going to focus here on the federal rule. And so once the date of that agreement, you have a year to meet the 10% test. If the 10% test is completed and met within those 12 months, then the property has the opportunity to extend the place in service date 2 years past the initial calendar year of the reservation year. So, for example, say the property was given a reservation of credits in today on July 14th, 2026. And then if they would meet the 10% test, their place in service date would now be December 31st of 2028. So if the 10% test is not met and completed, then the project would be subject to place in service at the end of this calendar year of December 31st, 2026. And again, at that point, the property is in jeopardy of losing their credit allocation if they fail the 10% test and they placing in service at the end of the calendar year of the reservation year, which means it would go back into the pool and that property would not be allocated any credits.
And as with so many tax rules, as you and I discussed when we were preparing for the podcast, there are exceptions. And there is an exception here when you're in a presidentially declared disaster area. So if you've had mass flooding, fires, earthquakes, hurricanes, tornadoes, your presidentially declared disaster area, then there is some extension of these various deadlines. And that is something that I've had lots of clients, I know you have as well, that maybe they met the 10% test and then they were looking like they weren't going to meet that place and service date. And lo and behold, they were in a presidentially declared disaster area. And that's one of the reasons why things got delayed and the dates can be extended. So it's something that I've definitely had more than one client that was running up against a deadline and wasn't aware of this rule. And they were starting to panic about meeting the test. And then this rule was able to apply and give them extra time, which kind of goes back to having experienced professionals. There's a common thing here. That'll be aware of these sorts of rules such that everything is preserved. Let's turn now to recommended practices. We kept talking about the 10% test, and you mentioned that's the minimum. There aren't too many investors that are going to be comfortable with you just barely meeting the minimum. There needs to be some cushion, and more cushion, the better. But you tossed out 13 to 15% plus or minus, basically more costs incurred. And I will say, as part of that, normally what will happen is there'll be, as you're going through and counting those incurred costs, they're going to want to make sure that there's a subset of those costs that are absolutely satisfied and there's no concerns around them. I won't go into all the reasons why there could be concerns around some costs. But with that, please either expand on that and or share other recommended practices with the audience so that they have a sense of awareness as to what others in the developers that are more sophisticated are doing and what investors are likely expecting.
I'll share here. I'll start at the beginning of what I'm seeing with my clients as well to help them meet the 10% test. First, you're going to want to track the dates. So we've thrown out a reservation and the allocation. So you'll want to track those dates so you know when the clock is starting to tick and you've got to know when the due dates are. And part of this is really staying organized along the way. As you obtain the documents, the executed documents, you incur the costs. You want to make sure you keep your files pretty clean because you will eventually be engaging with a CPA, which as a recommended practice, I will say that the earlier the better to get them involved. With my clients, we normally get notified as soon as really in the application process before they even know they're awarded with a reservation of credits. So it is important to make sure you have a whole team together, not just accounting, your tax attorney, all the team informed of what is happening. You'll also want to make sure that if you have the CPA engaged, as you're going through and incurring costs and completing the draws, it would be a good practice to share that information with your CPA. I have a client where we get monthly uploads from them as they complete a draw. So we are also able on our end to help track those costs and see where they're at along the construction timeline and when we can start on that 10% test. You can complete the 10% test at any point during construction in that 12-month period. So if you incur a bunch of the costs up front at closing and you're in that cushion of say 13 to 15%, you can knock it out earlier than the 12 months. But again, having that CPA there to help you along the way and guide you is a plus. And then I would say you need to understand state requirements. We mentioned earlier that the federal and state have different requirements. I know Mike and I were talking and he said the states are usually tighter restrictions or deadlines. And recently, I just had a client say that the state, it was for New Jersey, the New Jersey Housing Mortgage and Finance Agency is saying the due date for the 10% test needs to be 3 months after the federal date. So that was interesting to me. Always try to stay on top of those dates. Also with the states, each state will have different forms and submissions that are required. So it is important to visit their website or, again, engage a CPA who has experience in the states, and they can help you navigate through those state requirements. The federal deadline would be what we talked about previously, would be the 2 years, hopefully, if you pass the 10% test, the second calendar year after the reservation. The state requirement, if earlier, will need to be met. So that will also give you cushion with the federal that you would be meeting both of those deadlines. So again, just stay on top of those state requirements and plan ahead whenever you get that reservation.
Thank you for all of that. And I really appreciated your pointing out the monthly uploads from the developer to you. And I do think this is one of those areas where, having additional eyes keeps your eyes on the prize, or at least getting a lot of eyes on the prize can avoid unexpected pitfalls and other issues. So I definitely would encourage developers to have their own internal processes for satisfying the test, and then also adopting something like what you were suggesting so that there are multiple folks who are looking at it and monitoring it, given the significance of the test. Really like that point. I also just wanted to know, like I had said at the beginning, there's so much more we could talk about, but I feel like developer fee agreements are something that you really have to be focused on. And I feel like the industry this day and age, if you're working with experienced professionals, knows that the developer fee agreement, if you want to include 100% of it in eligible basis, it needs to relate to services that are capitalized to the project costs, to the development costs, the depreciable costs, and to the extent that the developer fee agreement references permanent financing and lease up and things like that, then some portion of the development fee won't get included. And it's the developer fee references land acquisition. The rest, some of it could be treated as land acquisition costs. So you basically want to have the developer fee agreement be focused on developing the building in terms of the hard costs, and the compensation for financing and all the rest coming in a different way, as well as land acquisition be compensated in a different way. And maybe we'll have you back, Karie, to talk more about the ins and outs of the developer fee agreement. Because that's
There's
a whole
plenty
other
to talk
podcast.
about. Yes.
And then one other item I'll just toss out there is those who are listening that are accountants and or controllers might be thinking, what's the accounting method you use? And generally speaking, like with developer fees, those won't be paid yet. So you're generally looking at this on an accrual basis. However, you're looking at it on the method of accounting of the partnership. And way back in the day, non-clients became clients because they weren't aware of that implication. And someone, the first year where the project costs were all incurred, they had some local CPA fill out the tax return, and they generally just pick cash-based method of accounting. And you needed the accrual basis method of accounting to be elected in order to accrue the developer fee. And that issue had to be addressed. So it's important when you work on these tests that you also are focused on those work in process tax returns. And we definitely have to remind new clients that it might be a work in process tax return, but it definitely needs the right eyes on that first tax return. Because I've also seen clients come to us where the other CPA did it on a cash basis and the cost of stuff didn't match with what was on the 10% test, which is not a good look. Anyways, I won't go into other horror stories because you and I could have a whole podcast on sort of horror stories. But fortunately, the industry has gotten so much more sophisticated and so much more common agreements that these sorts of issues are definitely rarer, not ones that you want to be ignorant of. Anything else on that, or can we move on?
I think we're good. I think we're good there. We could go down a hole here on this.
Which I'm known to do. I guess one last thing I'll mention is you talked about the state and the federal deadlines. And I always talk about the least common denominator rule. And most things about affordable rental housing is you have to be the least common denominator. Said differently, you have to structure the project to meet all the various requirements. So if the federal requirement, the state requirement, you've got to act in a way that meets both of them. And you always want to be aware of all the various agreements in place and that your activities satisfy all the various parties involved. Let's turn now to the documents that developers should be looking at or expecting. So when you're thinking of the 10% test, what are the critical documents that a developer should be aware of?
I would say there's two critical documents, the reservation letter and the carryover agreement, which we've briefly touched on throughout. The reservation letter is issued by the state housing agency, and it is the intent to award LIHTCs, low-income housing tax credits, to a project. And then there's the carryover agreement, which is an official document. It's the legal document that allocates the credits to the property. So this would be executed by both the owner of the property and the state housing agency. A good analogy I like to use here is similar to selling a house. So the reservation letter would be like the seller accepting an offer and taking the house off the market. And then the carryover agreement is really the purchase contract that is the commit to close, but is also still contingent on contractual requirements. So yeah, it clears it up a little bit there on the reservations, just the intent. The carryover is you have the allocation, you just need to meet the 10% test to move forward.
And thank you for mentioning this too. Maybe we should have you back for a podcast that takes us through the reservation letter process, the carryover agreement process, the place and service package. Maybe we'll
Yes.
talk about permanent loan funding before the place and service package and how those various points of time that you're interacting with the credit allocating agency. So I'm not going to come on this podcast. I've only been on with you twice. You've only come up with 2 other podcasts.
The timeline here can be a whole discussion of itself. There is so much that goes into this. I do want to mention that in addition to those two kind of main critical documents, it is important to keep the documents you don't think of as official or coming from the state housing agency. Those invoices that the partnership or that the property is incurring and the AIA documents for all those costs coming in from the contractors and everything, those are very important as well. The CPA that is engaged to perform the 10% test has to have those documents to be able to provide their report. So very important to keep track of your contracts, your invoices, closing statements, all of those documents together and be organized.
Maybe explain what the accountant's role is with respect to the 10% test, or said differently, how a developer has to engage a CPA to issue a report.
Like, are you saying as in what type of report or how do they go about
Or
it?
just the fact that a report exists. We haven't really talked
Okay.
about the fact that a CPA, that felt everything we've talked about so far, I could see a uninformed listener thinking, okay, I've done all this stuff and I submitted to the state agency. And we haven't really talked about the CPA has a role in this process.
Sure. The state agencies require that a CPA perform an attest engagement or an examination to certify those costs, to provide assurance on those costs. It may vary by state. So again, it's important to visit those state agency websites and determine if an audit is required, if an agreed upon procedure is required, or an examination. I have done all three for a 10% test. And again, the assurance provided in each of those is different. So it is important to, from the start, understand that cost that will also be incurred related to the 10% test.
Great. Thank you very much for that, Karie. Thanks for all the information on the topics that we discussed today. It was really enjoyable for me, as much as I wanted to go down a number of more rabbit holes. Before we close, what other resources do you recommend our audience turn to learn more?
As always, they can reach out to me. We also have on our website in the training section, there is a webinar specifically for the 10% test. It's Novogradac's 10% test for LIHTC developers webinar. We also have the LIHTC working group that if our listeners are not a member of, that's a great tool and resource to stay up to date on all the legislative changes and just to meet and talk about the LIHTC world. And then there are also 2 upcoming LIHTC conferences. One will be in Honolulu in September, and who wouldn't want to go there? And then a second is in Nashville, October 1st and 2nd.
And who wouldn't want to go there?
True.
Music City. And let me just emphasize, you mentioned the Novogradac 10% test for LIHTC developers webinar. I just would encourage every developer client, as well as underwriters, syndicators, and the like, to have folks on your staff who are responsible for underwriting and are responsible for the 10% test, who are project managers and the like. It's well worth having them watch the webinar. I have no doubt that they'll learn something every time and at least be reminded of something that they might have forgotten with respect to the 10% test. It's not all that long, and it's either a great refresher or a great first through about the 10% test. So thank you, Karie. Please do stick around for our off mic section. We've covered a lot to our audience. Today, we discussed the history of the 10% test, how it came to be applied the way that it is. We talked about how the 10% test is calculated. We discussed some of the traps for the unwary and recommended practices with respect to the test. And as I noted, there's a lot more than we were able to cover today. And to our listeners, I'll also note, if you receive value from today's podcast, I encourage you to subscribe to Test Road Tuesday on your favorite podcast platform. Please do also share the episode with colleagues, and do visit today's show notes for additional resources. And as I noted at the beginning, a quick reminder, our podcast platforms now include Amazon Music, Audible, and iHeartRadio podcasts. And as I say every week, if you have any questions or ideas for future episodes, please do send us an email at contact@novoco.com. So now we'll turn to our off mic section. Our frequent listeners and viewers know that we use this space to give a shout out to others working in the tax credit and tax incentive communities. It's an opportunity to highlight a professional who deserves recognition, and there certainly is not enough recognition of great work that people are doing in this world. So Karie, who would you like to shout out?
I'd like to give a shout out to Annie Hamlin of Project Freedom, Inc. She is their Director of Housing Development. Before joining Project Freedom, Inc., she was the Director of Tax Credit Services at the New Jersey Housing Mortgage and Finance Agency. Her expertise in the area has been tremendous, and she continues to advocate for the low-income housing tax credit community. And she is always willing to help out and share her experience with everyone in the industry. So thank you for everything, Annie.
Yeah, thank you as well, Annie. I echo Karie's shout out. Thanks for all that you did at NJHMFA. I first got acquainted with when Marty Burstein was there. I don't know if it was before you were born or not, Karie, but it was a few years ago, as Marty will attest if he hears this podcast. But thank you for all your great work, Annie. And thank you, Karie, for being on the podcast today. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.